Hi, everybody, and welcome back to video number 2 in Chapter 10. And when we left off, we were looking at this quick check to determine whether she would want to make an investment of $100,000. And I quickly went through that, but remember that our ROI will be the sum of this $60,000 plus this $18,000. That'll give you $78,000. And then the average operating assets will go up from $300,000 to $400,000 by adding that additional investment of $100,000 here. And that lowers the division ROI from 20% to 19.5%, even though this is probably a pretty good investment. So the company's required rate of return is 15%. Would the company want the manager of Redmond Onyx division to make an investment of $100,000 that would generate additional operating income of $18,000? Sure, they would. It's an 18%. 18,000 divided by 100,000. And that exceeds the minimum required rate of 15%. Okay, you can see the dilemma between that. So the Redmond Awnings then, the required rate of return for that company is 15%. What's the division's residual income? Give you a chance to figure that out. And the answer is 15,000. We take the 60,000 here and we subtract 15% of 300,000. That's our required rate of return. And that leaves us with a residual income of $15,000. Okay, if the manager of Redmond Awnings is evaluated based on residual income, will she want to make an investment of $100,000 that would generate additional net income of $18,000? And the answer is no, she would not, because the net operating, the residual income is $18,000 here. But it does yield an increase in residual income. But would she want to do that? No. All right, let's look at computing the throughput time, delivery cycle time, and manufacturing cycle efficiency, MCE, manufacturing cycle efficiency. Here is where we receive our order, and then we wait until the order is started, and then we process that order through work in process. And that involves processing it, inspecting it, moving it over to finished goods, and any queue times hit. So that throughput time then is going to be this time, which is when the production starts to when the goods are shipped. Okay, the process time here is the only true value added time. The rest of that is not value added. So this whole delivery cycle then, the process time is the only value added time. Okay, so the process time, let's go back. The process time is equal to the value added time. And so your manufacturing cycle efficiency is the value minus the added time divided by the manufacturing cycle time. So let's see how that works. Here, a TQM team at Narton Corporation has recorded the following average time for production. We wait 3.0 days. Our inspection is 0.4 days. Our processing time is only 0.2 days. Our moving time is 0.5 days. The queue time is 9.3 days. What is the throughput time? Well, what the throughput time would be the sum of the process time, the inspection time, the move time, and the queue time. So that's 0.2 days plus 0.4 days plus 0.5 days plus 9.3 days. All of these here, 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 and here. Wait time would not be included. Okay, so it comes out 10.4 days. Now, what is the delivery cycle time? The delivery cycle time in this scenario is going to be the wait time plus the throughput time. So the 3 days of wait time then, plus the 10.4 days that we just calculated, totals 13.4 days. That's the delivery cycle time. Now, manufacturing efficiency and manufacturing cycle efficiency, the MCE, what would that be? Well, we're going to take the process time here, the value added time, I should say, divided by the throughput time. And so that would be the process time divided by the throughput time. And so in this case, it's 0.2 days divided by 10.4 days, or 1.9%. Pretty poor, actually, right? So now we're going to understand here how to construct and use a balanced scorecard. We talked about that a little earlier in the slide, so let's look at it in a little more depth. Here, management translates its strategy into performance measures that employees understand and influence. Those include financial performance standards. Certainly we want to make a profit. Internal business processes, customer, and learning and growth. Okay, so what are performance measures, learning and growth? That's how are we maintaining our ability to change and improve. Internal business processes, have we improved key business processes so that we can deliver more value to the customer? And here, what internal business processes are critical to providing that value to the customer? That's our vision and strategy. So the customer then, from that perspective, do customers recognize that we are delivering more value? What customers do when we want to serve, and how are we going to win and retain them? Again, vision and strategy. Then financial. Has our financial performance improved? What are our financial goals? Again, vision and strategy. So a balanced scorecard relies on many non-financial measures in addition to the financial measures for two reasons. Number one, financial measures are lag indicators, meaning that they summarize the results of past actions. Non-financial measures are leading indicators of future financial performance. Number two, top managers are ordinarily responsible for financial performance measures, not lower level managers. So non-financial measures are more likely to be understood and controlled by lower level managers. The entire organization should have an overall balanced scorecard. Each individual should have a personal balanced scorecard. A personal scorecard should contain measures that can be influenced by that individual being evaluated, and that support the measures in the overall balanced scorecard. So there's important links associated with the balanced scorecard, and they should have measures that are linked together on a cause and effect basis. So if we improve one performance measure, then another desired performance measure will improve. The balanced scorecard therefore lays out concrete actions to attain desired outcomes. While that sounds very good in theory, it's somewhat difficult to implement in practice, but it is a very valuable technique and one that I certainly support. So incentive compensation then should be linked to the balanced scorecard performance measures. So let's look at Jaguar. Here, from a financial standpoint, we want to make a profit, and that includes the contribution to that profit per car. From a customer standpoint, we want to look at how many cars we sold. But we're not going to do that unless the customer is satisfied with those options, and then that in turn dovetails into the contribution per car. Internal business processes include a number of options that are available. One would be the time to install an option, and that option may be very valuable to a customer and add to the contribution per car. And then learning and growth are employee skills in installing these options, right? And as we get better at it, we increase our financials, we increase our satisfaction with our customer, etc. You can see how that builds. Okay. So we want to have a strategy maybe that increases the options that are available, but we also want to make sure that that results in a satisfaction by our customer with those options. That in turn will generate more cars sold, and in turn generate more contribution per car, and in turn generate more profit. And of course, efficiency-wise, we want to take time to install that. We want to see that time decreasing. And we will be able to do that if we increase the skills of those employees installing those options. Okay, so the final result then is cars sold increase. Satisfaction from the customer increases. Everything works. And here, the contribution per car increases, the customer satisfaction increases, and the time to decrease the installation of the options decreases as well. And here, if the number of cars sold and the contribution per car increase, then the profit should increase. Okay, that looks like the end of chapter 10. And when we return, we'll take a look at the appendix for chapter 10. Until that time, bye for now.